if I took a quick poll now, and I've done this in other webinars, we won't do it on this one because of the number of people here, but people will tell me things like, well, the decisions I make in my business revolve around hiring people and advertising and marketing decisions, and do I increase my staff wages, and how do I compensate my staff, and do I buy a new location, or do I buy a new piece of equipment, or do I get a new bank loan so I can expand, and what do I pay myself, and all those things. And I hear them all the time, and so I know this is how a lot of business owners think. The problem, however, is really that's not what the decisions in your business truly revolve around. Those are kind of like the macro part of it. But what your decisions really, really, really revolve around are your customers or your clients, if you're a professional services business, your products and your services, and your activities. Now just take a moment and think about any decision you make in your business, or any decision that you know you should make, but you've been procrastinating on or neglecting it or not making that decision. And it will fall into one of these three categories. Marketing and advertising, well, it touches the customer side of things, obviously. It also touches the products and services, and even the activities. It's how we go about doing that. Hiring more team members or laying team members off, again, are driven by how many customers do we have, how many do we think we're going to get, how long does it take us to deliver our products and services, what activities do we need our staff to do or our team members to do. So anything in your business, any single decision is in one of these three categories, or a combination of these three categories. And again, this is that Mark and Tracy moment I talked about at the beginning. This is what I realized I had to give to Mark and Tracy. Right? The financial perspective of the business of revenue and expenses is simply the end result of these three things. So if you want to drive your financial result and you want to change your financial result, this is where you have to make decisions, because this is where you actually create it. So let's step back for a minute and look at an example of how not to think about 2013. So suppose now, we just finished 2012, and now if you're like a lot of business owners, you don't even really know what you made in 2012 yet, because you have to take it to the accountant and see what happens, and don't get me on my soapbox there, because you should know what your financial results are week by week and month by month. And there's ways of doing that that don't involve waiting for it to hit a financial statement or a profit and loss and a balance sheet. But just assume for a minute that 2012 gave you $65,000 net earnings, and it broke down as this. I just made these numbers up. Revenue was $250,000. Your direct costs of producing those sales were $100,000. That left us with a nice gross profit of $150,000. We had overhead of $85,000, and voila, we had net earnings of $65,000. Now, whether that is your number or not, or your number's a lot bigger or a lot smaller, doesn't matter, because this is just an example. So here's how not to think about 2013, and here's, unfortunately, how most business owners do it. So they ask, well, that was 2012. What's 2013 going to be? And they look at themselves and kind of scrunch their face up and they scratch their head, and it's like, well, maybe we can increase revenue by 5%. And if I get really hard with my suppliers and maybe manage the overtime of my team and do a few other things, I can reduce direct cost by 2%. Maybe I can shave my overhead by 3%. I'll pay for less mileage, whatever it is. This tends to be, as business owners, how we think about next year, right? This is 2012, and I'm just going to play with these little increments and bump revenue and drop cost and shave this and shave that. And at the end of it, look what I'm going to make. Wow, 2013 is going to be a great year, way better than 2012, because the math I just did means revenue is going to go from $250,000 to $262,500. Direct costs are going to actually drop because I shaved them by that 3%. And then my overhead I dropped by a few percent as well, so it's going to go down. So at the end of it, on paper, I'm going to make $82,050. And the problem is, this is not at all useful as far as creating a financial result. But as business owners, we tend to be trapped into doing this exact thought process, because really, in a lot of cases, there's no other mechanism that we've learned. Right? So we look at a financial statement, we look at a profit and loss, we look at a balance sheet, and that's all we can do. That's all we can go with. And we're left and reduced to doing this. The problem is this doesn't do a single thing to tell us how to create that result. Right? Increasing revenue by 2% or 3% or 5% is just math. It's that Mark and Tracy moment again. This is exactly what I showed Mark and Tracy, that at the time they were delighted by, and at the time they said, thank you so much, we wish we had known this several years ago, and impressed them. But when it really came down to it and they walked out of my office, Mark and Tracy had no idea how they were going to take revenue from 250 to 262, 500. Well, they kind of had a hunch, well, maybe we'll get more customers or more clients, we can try some more marketing, but really no clear line of sight. From here, the 250, to there, the 262.5. So what's wrong with thinking about it that way? Well, I kind of let the cat out of the bag a little bit, and I told you that, you know, we can't create that number. That's just mathematics. Because the problem really is revenue, guess what, isn't revenue. And direct costs aren't direct costs, and overhead isn't overhead. And you know, sometimes when I get together with my accountant friends, they'll tease me a little bit because they think I have this non-accountant mind, which I, by the way, take as a compliment. But really, as a business owner, you've got to get out of your mind that revenue isn't revenue, what you would traditionally call it on your profit and loss. And direct costs aren't what accountants call direct costs, and overhead isn't what overhead or what accountants call overhead. What all of those things really are is what? Well, now I'm totally puzzled. If revenue is not revenue, direct costs aren't direct costs, overhead isn't overhead, Steve, I'm stumped. So what is the answer? Well, revenue, direct cost, and overhead, in other words, the amount of money your business makes for you, your net earnings, are created by, voila, does that look familiar? Your customers, your products and services, and your activities. So remember a few minutes ago when I talked about those theoretical 1,200 decisions we're going to make between now and the end of 2013? Well, every single one of them related to what? One or more of these three things: your customers, your products and services, and your activities. So because of that, let's just step it back one little level. Therefore, those 1,200 decisions, every single one of them affects one of these things. Therefore, every single one of them affects your financial result, either good or bad. Now, we can do something with this. We start to deconstruct revenue and direct costs and overhead into customers and products and services and activities. We can get our hands around that. Right? That's visceral. We can feel that in our business. We can see it. We can measure it week by week, day by day in a lot of cases.